Well, let's just start. This is going to be pretty informal, guys. I'm going to have a little Q&A with Peter, and then Peter's got a pretty interesting presentation I think I saw some version of a couple weeks ago. And then I would love for you folks in the audience to be thinking of your best awesome questions. I'm sure his presentation will inspire many questions. But Peter, let's just start off. Who are you and what do you do?
That's a pretty existential question for this
Yeah.
early in the morning, Nathan. I am the head of insights at Carta. So I have what I consider to be maybe the best job in venture capital. I get to sit on top of our aggregated and anonymized data from close to 50,000 US startups, and I get to report on that data back to the ecosystem, tell people what's going on in the market, help founders and investors make better decisions about VC, fundraising, valuations, building startups. Venture has become this everyone's favorite asset class, it feels like, over the last decade. And we try to shine a light on the parts of it that are still kind of opaque.
Very cool. How much of your work is reporting on that data versus like analyzing the data? And I'll preface that by saying I can't turn around in San Francisco without seeing Peter speaking at some event. You are everywhere. I don't know if you've cloned yourself somehow already, but you are literally all over the place. So yeah, how much time do you spend actually like going through data and digging through data and yeah.
Yeah, our second product after cap table is definitely cloning. We've been working on that internally
Cool.
for a while. Yeah, it's not quite ready for prime time, but I glitch out enough that we don't want to offer it over. No, man, it's so funny when I came in. So I've been at Carter for 4 years, and I came in. I sort of pitched this job to the folks here because Carter has such an incredible data set, and I thought we could use it better. And so my first year and a half, 2 years here were very much data analyst, internal strategy, like behind the desk, not as front facing. And then as we've kind of grown the public side of this, I do spend about half of my time now talking to audiences, and it's so much better. Like my firm wish is for everyone who thinks about data to go and talk about data to people, because you just learn so much more from the talking and the questions than you do from just sitting behind a desk and kind of thinking it through yourself. So the feedback has been, I think, the major reason why this has actually taken off.
Yeah, and it's pretty cool. I mean, what you do because you're gleaning this data, massaging it, putting it out there, and I'm sure it's influencing how people are kind of building their startups. And you probably have some little feedback loop on that too, maybe, right? I mean, do you get
Yeah.
people like, hey, I structured my co-founder's equity split based on a talk you gave or a piece you published? Like, do you get kind of a little feedback loop going?
Every single day.
Yeah.
And it's fantastic. Uh, just because it can feel, especially for entrepreneurs that are not in Silicon Valley, it can feel like there are so many of these hidden rules or norms or whatever that you just don't get access to unless you have got a great lawyer or a couple friends who are founders. And so, like, if we're gonna conceive of my role as anything, it's giving first-time founders what second-time founders already have. And
Mm.
that's what I want to do with the data that we have. And then, of course, the exciting part about Carta is we've moved from just the founder platform to founders and investors. We're the back office for nearly 3,000 venture funds. So having both sides of that equation, the fund side and the founder side, makes the data all the richer. So that's like the goal for the next couple of years, is to become the go-to source for fund information, just the way that we have for founders.
Yeah, really cool. All right, we'll get into your presentation in just a minute, but what's your backstory? What were you doing before this? How'd you get into this? Were you a data nerd since childhood?
Since birth, really. Yeah. Hasn't everyone? I so when I started a company in college, and then we sold that business like as we were graduating. I don't know if I would call it a tech startup, but it was fun. And then it was all small startups from there. So Carta's the biggest place I've ever worked by a factor of five. Um,
How
so
many
it's
people are at Carta nowadays? How big is Carta?
1,600, 1,800,
Okay.
something like
Uh-huh.
that. Yeah, pretty big. And then, so small startups, data analytics and marketing roles, et cetera. And then really the thing that turned me onto this as an idea was during the pandemic, had a moonlight second job as the head of data visualization for the Atlantic magazine for their COVID project. So they were collecting data all over the US and visualizing it to talk about COVID. And it was such a like click on moment to say, if you are at an organization, company, or otherwise that has a data set, like the number one thing that you should do with your marketing is talk about that data set all the time. And there's almost, if the data set is good enough, there's almost no end to the questions that you can ask and the interest that those questions can generate. And then you're not, you're not sitting there going, buy Carta, buy Carta, buy Carta. You're actually helping, giving people a sense of what their world looks like. And then hopefully they have a great, halo effect to the rest of the company. I got lucky that the execs here at Carta felt the same way.
Yeah, really cool stuff. I'll be candid. We're stealing a tiny bit of your playbook. I've got a guy who's going to run some data sets on our stuff because,
Good.
we're trying to crack the code on fundraising and, we're trying to figure out, okay, on average of the startups in our platform, we've had almost 100,000, like how many investors did they contact before they got that first commitment, right? Like little
Oh, yeah.
data sets like that only we have. And so I'm stealing a little page from your playbook because I think it's really cool what you do. So anyway, that's why you're here.
That is literally that's music to my ears, and it's that's great. If I want to do anything, I want to found this little function within marketing teams of like, be data driven. Give data content back to your audience. They'll love you for it.
Yeah. Yeah, I don't see too many people like you out there. Maybe I guess not every.
We're growing. There's less than a dozen of us, but we're
Yeah,
we're growing strong.
interesting. All right, well, with that segue, why don't you share screen and guys on this call, why don't you start putting your questions as they come up into the Q&A. We'll kind of let Peter go through his talk here. Um, but yeah, go for it. Let's do it.
Absolutely. And as Nathan mentioned, if you have questions, actually throw them into the Q&A or the chat as we go along. Sometimes I can see those and wrap them into the narrative here so that as we go along and so I don't miss all of your good points. But okay, tons of data to show you today on what we call foundational equity. And that phrase for us means who owns portions of your business before you get to your first institutional priced round. So we're talking co-founders, we're talking advisors, early employees, pre-seed, and maybe even seed angels, depending on how you do that fundraise. So like the initial, call it year and a half to 2 years of your cap table, we've tried to wrap up into this talk. This is from our lawyers. I'm required to show that. And yes, you can totally get this deck if you find it interesting. Happy to share it out afterwards. Shoot me an email, peter.walker@carta.com. Happy to share those. So, when you're building a startup, and I got to be honest, the vast majority of the data that we're talking about today is startups who are trying to raise venture capital at some point. We'll talk about the decision-making structure as to whether or not that's you or that's not you. Raising VC is just one way to build a business, not the only way to build a business. But if you do raise venture capital, the mechanic across all of these topics is dilution. So you start with the whole cap table, you start with 100% of that pie, and you give out slices of that pie, decreasing your ownership percentage over time while hopefully raising the valuation of the company so much that you don't mind that you only own 10% of it at the end because, hey, that's 10% of $1 billion and you've done incredibly well. So if we flip ahead a decade from now and you are IPOing on the NASDAQ, we took a look at, this is actually data from Jason Lemkin at SaaStr, who looked at a lot of different SaaS companies and the amount that the founders owned on the day of the IPO. There's founders like Atlassian's founders who owned more than 3/4 of the company themselves between the two of them. And then there's founders like the DocuSign founding team who had less than 2% of their own company on the day they IPO'd. The point is not that the people at DocuSign did this poorly. The point is that dilution can quickly get away from you if you're not careful about it. So it's just the meta concept around where you're going to be over time. And then, of course, AI today is throwing things off. Anthropic is about a $60 billion company right now. They have 7 co-founders. Each of those co-founders has 2 to 3% of the company. You can do that math. That's a pretty amazing outcome, and they're nowhere close to an IPO yet. So when you're talking about dilution, you got to start with your co-founders. This is the biggest choice really that any of you are going to make with your businesses. Who are you founding this with? The first note is that we took a look at the 44,000 or so startups on Carta, and there's a one clear pattern that emerges with co-founders, which is lots more companies are starting with just one founder. Solo founded companies becoming far more common year over year. However, VCs don't love solo founded companies. You'll talk to them, they'll tell you, oh no, we totally invest into solo founders, and then most of them do not. So the percentage of solo founded companies in the ecosystem is much larger than the percentage of solo founded companies that actually get VC funding. So if you are starting with one founder, just know you're on a bit of an uphill battle when it comes to talking to VCs. But most of you probably are starting with at least one co-founder with you, maybe 2 or 3 or 4. And so you come to this initial choice, which is how are we going to split equity? The 2-founder team that splits 50-50 is becoming more and more common. That's that orange line at the top of this chart. So about 45% of 2-founder teams split equally in 2024. Now, a lot of that is just defaults around startups. YC has promulgated the equal split for a long time, but actually more than half of companies, and actually probably more than 75% once you include the bigger founding teams, do not split equally. 50-50 is not the most common split. It's totally fair, but it's not the most common. So how do people actually split equity amongst themselves? If you just look at the median, if you have 2 founders, the median on Carta is 51-49. So unequal, but very, very close. If you have 3 or 4 or 5 founders, the equity split tends to be slightly more unequal, and it tends to favor one founder over the others. So founder A in this table would be what we would call the lead founder. And yes, that lead founder is almost always the CEO. So if you have 4 founder friends with you, probably one of you is going to take on an outsized portion of equity. So there's not a moral way to do this. 50-50 is a great way to split the business. 55-45 is a great way to split the business. The only terrible way to do this is to, 1, not have a conversation about it and just assume everyone's cool. You might get bit in the ass later on as someone had very hurt feelings about their equity. That happens a lot. And the second way to kill your startup in these kind of conversations is to have no vesting schedule. And so founders get kind of mad when we talk about this sometimes because they go, it's my business. I should own my equity outright. If you're trying to raise venture capital, that is the exact opposite of what you should do. And the reason is actually to protect yourself just as much as it is to be nice to VCs. So imagine a situation in which you started a company with a co-founder. You each owned 50% of the business outright at the day of founding. 2 years in, you get in a fight with your co-founder, that person leaves. Now you have 50% of the business that is not helping the business, what we call dead equity. That will make conversations with VCs very, very difficult. In fact, I'd be shocked if you're able to fundraise in that situation. So vesting schedules can seem annoying, but they actually protect you from co-founder exits that might happen in the early years of your business. So traditionally, we have founders follow the 4-year vesting schedule. So it's a 4-year vest with a 1-year cliff for employees. Founders typically just take a 4-year vest, no cliff, starts vesting immediately. We have seen some founders do 5-year vests, even 6-year vests. There's some VCs who think that founder vesting should be much longer than it is now because it takes a decade to build one of these businesses. I think that's talking their own book a little bit. I don't think you need to put this at 5 or 6 years immediately, but I think 4 years is a great starting point, and then you can extend it over time. And the last point about founders is A, vesting schedules are a must for sure. And then B, you're going to get a different kind of equity typically than your employees. So you typically give yourselves restricted stock awards, which is real equity, versus an ISO, incentive stock option, which is the option to purchase equity at a lower price in the future. So a little bit of nuance there. We can help you with that on Carta if that's ever a worry. I'll pause for a sec. Any questions on founder equity? I know I just kind of breezed through that quickly.
I'll throw one out. Why is it generally no cliff? Why do you think that's a common there?
Because founders don't like the idea of putting themselves on a cliff. They're already kind of annoyed by the vesting schedule in the first place. So, and to be honest, the cliff doesn't make that much sense given that if they, the cliff is basically to incentivize someone to stay for at least a year. That shouldn't be a worry with founders, but obviously there are some probably horror stories about that as well.
And just for anyone not familiar, a cliff is basically for that first year, if you leave 11 months in, you walk away with zero, right? I mean, that's kind of the definition of the cliff. Is that correct?
Exactly right. Yes. So the vest is you earn equity over time, and the cliff says, okay, but for that first year, no equity because we want you to stay for that full first year before you receive anything. We can argue whether cliffs are fair or not. I think that they're certainly default for employees, but founders typically avoid them.
Very good. Yep.
Okay. So we've moved from founders. You're building a business. Maybe you now want to bring on some advisors. Whenever I have this conversation with founders, they tell me from the advisor community that what they're hearing is the advisor would like 1% or so of the business. How did they decide on 1%? I don't know. Maybe there was an advisor convention where they all sat down and said, hey, here's what we're going to say. But that is not the market. 1% of your company as a pre-seed company is more than 9 out of 10 advisors receive. So 1% is a lot of your business. Typically, what we see is that advisors receive about 0.25% of in equity for their advice. And I'll structure it this way. Typically, that is a 0.25% over 2 years. So not 0.5, but 0.25 over the full 2 years. And it typically starts vesting. I mean, some of them have a cliff, some of them have a small cliff, some of them have no cliff, et cetera. But a quarter of 1% for pre-seed advisors. And then obviously, as your business matures, you pay less, quote unquote, in equity for that advice because you're a more mature business. There are some advisors who are worth a lot more than that, right? If they are actively introducing you to contracts and real clients, if they are a technical advisor helping you through a very thorny technical problem, we see this in biotech or hardware. But in general, if this person is, teaching you how to sell to SaaS companies or they're like advising you on some hiring, 1% is too much of the business. So yes to vesting schedules, they typically get 2 years with a short cliff, and then they get NSOs, non-qualified stock options, because they are not full-time employees, so they cannot receive ISOs.
Peter, I'm going to jump in with a question. Do you see folks, because most people on this call are raising capital or thinking about it,
Yep.
are fundraising advisors or people, you talked about the biotech example. I think that's great. Someone who's going to help you sell into the enterprise. That's a great example. People who are helping you fundraise or making introductions. Do you see that equity percent being higher, lower, or is it kind of standard across the board? Do you see anything?
I mean, maybe a controversial take. I think the vast majority of fundraising advisors are kind of bullshit and you shouldn't use them almost ever. Especially if you don't know them.
Right.
It is the easiest thing across Silicon Valley and startups to say, oh, I have all these great relationships with investors. I'm happy to get you in front of blah, 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 blah. Like most fundraising advisors are kind of scam artists, having spent 4 years now talking to fundraising advisors. In narrow cases, it does make sense. What I would do is I would tie that equity to performance very, very, very deeply. So it's not just a regular 2-year vest where you just give them the equity no matter what happens. You should tie the equity percentages to actual outcomes. So if you get me meetings with these 3 specific investors, then you receive X% of the business. But in general, And sometimes, to be fair to the advisors, sometimes what's happening is the founders are trying to outsource the fundraising process. You cannot do that. You are the fundraiser. So you cannot, nobody else should be fundraising for you. You have to be in all of those meetings.
And I'll echo that. I get that question all the time. Can you introduce me to someone who will do this for me? No, that doesn't exist. That doesn't happen.
100%.
Only, yeah. So
The idea that you just get to build product and not talk to investors if you want to raise from investors is a fiction. Get used to talking to investors for sure. Couple questions in the chat uh, on this. Is it possible to pay equity to an advisor's estate? David, yes, it is. It's a little tricky, or you could work that out, but it's totally possible. Um, and then another one earlier from Edwin on how to address the diminished performance of a co-founder. Edwin, this is really hard. Uh, if one of the co-founders 2 years into the business is not performing up to what the rest of the team thinks that they should, those are tricky conversations. What I'll say is if you have the vesting schedule, at least you'll be having those conversations in an environment where if it ends up being bad and you have to, part ways, they won't walk away with a full chunk of equity. They'll only walk away with what they vested. So it's a really tricky thing though. I mean, that's why we say co-founder disagreement kills more startups than you would expect for sure.
yeah.
Michael asks, it's hard to legally compensate fundraising advisors based on performance. It isn't actually hard to compensate on performance that is not dollars. So performance as introductions, et cetera. Many advisor contracts are structured with performance criteria like that. Can your vesting schedule among founders, this is another question, be also tied to performance? It could. I would say most founders would push back on that and say, look, I'm doing 1,000 things. Why am I being judged on one criteria when it's, I'm helping build the business? But these are all great questions to ask your founders during that initial conversation about who should own what. This is a great example of have that conversation. Don't avoid hard questions. Be honest and upfront with your co-founders, or else there might be simmering resentment over time. Okay, so you've done advisors, you've had these hard convos with your co-founders. Now you're going to start hiring employees. So first off, you're going to set aside a portion of equity for these folks, typically known as the employee stock option pool or ESOP or option pool. First note, sometimes you'll hear you need to have that option pool as 20% at the beginning. That is a lie. Start it much smaller than that, like 8 to 10% for your pre-seed. You can start hiring employees, et cetera. And then as clearly shown in this chart, as you fundraise, you're going to expand that option pool over time. But there's no need to do it up front because then you're taking on that dilution. Whereas if you do it over time, your investors are helping you with that dilution, et cetera. It's, Gail asks with a price round, what if it's on a safe? That's also still about 12%, 10 to 12% on the option pool side. And then, a couple other questions on advisors for revenue or compensating advisors on a referral program. Those are all fair ways to do it. You do want to be careful about if there's any legalities that you have to go around in terms of fundraising advisors. But again, in general, y'all, fundraising advisors are like a part of the game of venture is can you get a warm introduction? Now, paying for that warm introduction is one way to do it. That's not the only way to do it. In fact, when you talk to a lot of VCs, and this is kind of annoying of them, they say how a founder got to us is an example of how this founder acts and thinks. So we kind of want you to be creative on how you get a warm introduction to us. That's obviously self-serving on the VC's part, but it is kind of true, unfortunately. Okay, so what are you going to pay these early hires? The median amount of equity that hire number one, meaning the first non-founder in a startup, received in 2023 was 1.5% of the business. That's a 4-year grant, so not 1.5% per year, 1.5% over the full 4 years. And yes, this data is slightly stale, but when we're about to rerun it for 2024, and it's going to be right about maybe slightly less, but about right in that 1.5% range. So two things stand out from this chart to me. The first is that founders got a little bit more generous with their equity grants for the earliest employees year over year. And the second is that, damn, that equity falls off really fast, right? Hire number one getting 1.5%. Okay, you can debate, is that good or that bad? But hire number five getting 0.34%, much, much less than hire number one, while taking on, let's be honest, basically the same amount of risk, right? How de-risked is the business after 4 employees? Probably not very much. So you as the founder hiring these early employees, convincing the right people to join your startup, employees number, call it 4 through 20, is one of, if not the biggest challenge in my book. Now, maybe AI is changing that, et cetera. But finding the right people who are mission driven for your business is such a gigantic part of being a founder. And so equity is obviously one portion of it, but you got to convince them. If they're just joining for equity, they're probably not the right person. Great questions in the chat. Michael, yes, we see option pools pre-seed for sure. If the non-founders are not being paid, you should definitely pay the non-founders in equity or in salary, one or the other. Compensating founders with some of the ESOP. Don't do that. Founder stuff should be separate from the ESOP. Keep the
But
questions
Peter,
coming.
to be clear, these early employees are coming out of the ESOP, right?
Yeah, for
Yeah.
sure. Yep, for sure, for sure. Okay, and then if you looked at that 1.5% number and you were like, that's super low or that's super high, congratulations. Your fellow founders agree with you on both sides. Sometimes it's 0.5%. There are first employees who get 4% of the company, right? These ranges are very wide. And that just points to the fact that hiring your first employee or even your first couple employees, it's an art, not a science. Yeah, our data hopefully is a little bit helpful, but you probably have a personal relationship with these people already. Maybe you've already worked with them, et cetera. Like there's 1,000 considerations that come in here. So if you are sitting there going, this is the absolute right person, but they're asking for 1.75% instead of 1.5, do it, right? It's gonna be much, much more important to you in the long term to have the right people in the company. Typically in startups, employees, even the early ones, have that typical vesting schedule that you probably are familiar with if you've worked at a startup, which is a 4-year vest with a 1-year cliff. And everybody, basically everybody, receives incentive stock options, ISOs. If you want to be super generous, you could give those first couple employees what you get, restricted stock awards instead. That's just another perk for them as the earliest joiners. So something to consider. I'll pause for questions on equity side before we jump into fundraising.
I'll throw one in there. So that first employee, first hire, key hire, 1.49% equity, and then on top of that, you're setting out an ISO uh, reward system, or
No, typically that's given as an ISO.
okay,
But again, if the founder wants to be generous, they could instead give that 1.5% as an RSA, which just has a bit of a tax advantage for those employees.
got it.
I don't think that you should. Kathy asked if you should give RSAs for advisors. I would not give advisors RSAs. I would give them NSOs. And then Suraj, your question is, how do you price incentive stock options? Great question. Come to Carta. We do that every day for you. It's through a process called a 409A valuation if you're here in the States. But basically what you do is you set a fair market value as assessed by some independent third party, which Carta can be for you, which gives those options at least some sort of value. At the very beginning, it's 0.0001 cents or something. It's very, very small, just so you're legally all compliant, and then you can grant equity to your employees. Okay, pre-seed funding. So data first. This is all of the dollars up there on the top That's cash raised by companies in what we're calling pre-seed funding. So in this case, we use pre-seed to mean pre-priced rounds. So anything that was done on a safe or a convertible note before the company had raised any priced equity funding. Priced equity is your typical VC deal where you decide on a price per share, you have lawyers involved, it's a long process, all that stuff. So one thing on this chart, about $1 billion or so invested into this part of the market on Carta over the last couple quarters, a little bit lower in Q1, you can see. We think that's going to probably bounce back a little bit in Q2, but there is still funding for pre-seed startups. It's still an active part of the market for sure. The question you should be asking yourself, do you really need to fundraise? It is the question around startups today. How much money do I need to build this business? And the second question you should ask yourself is, no, really, do I need this capital? How much do I need this money? If I were, for instance, to build bootstrapped for a while and then take a loan from a bank, as soon as I pay that bank back, I don't have to talk to the banker. If you take money from VCs, you will be speaking to this person once a quarter for the rest of your life, or at least until your company IPOs, which can feel like the rest of your life. So VC capital is very expensive. Only take it if you're sure that you need it. Which brings us to how do you fund your company? Companies are all over the place on this these days. It's the biggest shakeup in startups really over the last few years is many founders are trying something different than that full VC route. So maybe it's bootstrapping where it's just your money and revenue. Maybe it's full VC where you go through every alphabet stage. Maybe it's seed strapping where you try to take one round of VC and then no more. Or maybe it's late VC where you actually start like a bootstrapper, but your company gets big enough that later stage VCs get interested in it, and then you take on some capital at that point to really fuel growth. All of these are great ways to build a business. There's no wrong answer here.
Guys, put in the chat which of these four models you are thinking of pursuing. I'd love to see a quick little poll here on Foundersuite's seed strap. So, we raised money, but hopefully you don't have to raise more. Put in the chat what you guys are doing.
Totally.
Seed straps. Interesting. Full VC.
Yeah, people love a seed strap these days. I would love for those of you that seed strap to come back in a year. We'll rerun this webinar and we'll see how many of you that thought you were going to seed strap stayed on that path. I am so excited for people to try it, and I wonder if it's going to work for a lot of folks. We shall see. We shall see. I don't want to prejudge the data. I love it. Stuart, you're already public. Congrats. You won. Well done.
What are you doing here, Stuart?
Thanks for coming, Stuart. I love that you're here, but I don't know if I'm that good a speaker. Okay. So if you are thinking about going the VC route or just raising seed strap, angels, whatever, you're going to encounter these two documents, a safe or a convertible note. The safe is the most common way to take in money for your business at the earliest stages. It stands for Simple Agreement for Future Equity, built by Y Combinator and Wilson Sonsini, the law firm. If you're not familiar with safes, go to carta.com/safes, learn about them, get familiar with them because they will be the way that you fundraise for this initial capital, probably. Convertible note, same thing as a safe, except for it has an interest rate, which means it's actually debt, which means it has a maturity date, which means people are annoyed by it, blah, blah, blah. It's not as fun. As I mentioned, 90% of the data that we see on this part of the market is that people are raising on safes, not convertible notes anymore. The only place where that's different is if you're raising in biotech or really hardware businesses building physical products, you might encounter more convertible notes. But if you're building a software company, you're almost certainly raising on a safe. Two terms to know from a safe. There is the valuation cap and there's the discount. You can use both. You can use neither. You can use one. You can use the other. The valuation cap is the maximum price, the maximum valuation at which that safe will convert. The discount is the minimum price at which that safe will convert. So you can think of them as the ceiling and the floor of the safe. And then there's pre and post money safes. Pre money excludes company capitalization. Post money includes. Basically, the post money is more investor friendly. The pre money, depending on how you use it, is more founder friendly. So, Andre, that's a great point, by the way. Note in the chat, the U.S. safe is wonderful for the U.S. and a couple other countries. It is not universally used in other places that are not the U.S. There are some safe equivalents in different places, but like be very careful with the jurisdiction that you're raising in. All of this data is about the U.S. So most safes have a valuation cap, about 90% of them. Some safes, call it another 30 to 35%, have a discount. And then if you get an uncapped, undiscounted safe, that's from your parents or somebody who really loves you. Those don't really exist in the market. And the black part of this bar, the gray part of this bar is post-money safes. The blue is pre-money safes. As you can see, the post-money document has become the default. This is an interesting story, actually. Part of the reason why this happened is because Y Combinator literally took the pre-money document off of their website. You cannot find it on Y Combinator anymore. And look at that. The default in startups took one PDF off of a website, and look what happened to the data. It's absolutely wild how important some of those defaults actually are to how we raise money and the way that we think about startups. So,
do you know why they did that? Is it more founder friendly or
no? Post money is more investor friendly for sure, no matter what they say. That is a lie. They've said that before, but it is not true. Post money is more investor friendly. They did it because it is much clearer, as we'll walk through an example. It is much clearer who owns what in a post money safe. It just makes things a lot simpler. Maybe that simplicity is founder friendly, but the actual math is not. And here's the reason. If I give you $1 million on a 10 million pre-money cap safe, I, as the investor, have no idea how much of your company I'm going to own at that moment. If I do that exact same deal on a post-money safe, I can be pretty sure I'm going to own around 10%. It'll be less than 10% because of option pool dynamics and other stuff, but it just gives me more clarity about what I'm going to own, because the 10 million post money doesn't care about any other money you raise on safes between now and the first price round. It gets a little confusing. So we'll walk through an example of how this works. So if you're doing this in Carta, it looks like this. I am Peter's angel group. I gave you 500K post money safe on a valuation cap of $5 million. On that day, I, the investor, don't get anything. No shares, no ownership, no nothing. Because it's a simple agreement for future equity. So nothing converts yet. A year down the line, you go ahead and raise a round of $3 million. You raised it at a pre-money of 14 million, et cetera. You gave an option pool. And now I own shares. So on your first price round, the safe converts. And now I, the safe investor, own some shares in your business. You can play around with these price round terms on Carta. You can model it out and see how all this affects you. Really easy to do. You can do that for free. The one note that I'll have is, as you stack safes, as you raise more money on safes at different valuation caps, the math gets harder and harder, and you might end up diluting yourself more than you think. So safes are great. You can start on safes. Do not stay on safes for 3 or 4 or 5 rounds. Too many founders are doing this and they are putting themselves in a hole. And it just feels better to do it because it's quick and easy. You don't have to involve lawyers. I get it. But at some point, pay the lawyers, do the price round, clean your cap table, and kind of move forward on that basis. All right. Eli, no, post-money valuations do not include the option pool unless it's negotiated otherwise. Post-money safes lessens dilution for earlier safe investors. Yes, Kareem, you're right about that. That's why it's very nice for investors. Seed strap startups could never do a priced round, or they could say the seed round is a priced round. Rob, it kind of either way would work. A lot of people are raising seed rounds on safes, though. And then the question is, okay, if I seed strap this on safes and never convert it, do my investors get any equity in my business? or did I just get a grant from them? Don't be that founder. Convert the safe if that's the route you're going to take.
When would they convert it? Like if it were a seed strap company.
Whenever you want to. There's no mechanism in the standard Y Combinator post money safe for a conversion that is not a qualified financing. So in this case, if you raise a seed round, if you raise 2 million bucks on a safe and say, we don't need any more money ever, you don't technically have to give those investors anything. It's not good, not a good business partner, but there's no reason on the safe to do it. Now, there are modified versions of the safe that say if this hasn't converted after a period of time or whatever, there's other things you can do, but I have heard from some investors that they're worried about that.
Interesting.
Okay, other stuff you're going to come across in a safe. It used to be that safes were really simple. It was like a one-page document. You signed it, you're all good. Now, if you're working with a real fund, so not angels, but an actual institutional fund, they say, cool, we'll do an investment on a safe, but you have to sign what's called a side letter. And those side letters give the investors more rights than they would have gotten otherwise. So some of the rights that they ask for, MFN, most favored nation, which just means if you give anybody a better deal than we got on this safe, we get that deal too. Second right they always ask for is information rights, which means you have to tell us how your business is doing every quarter. I think that's actually pretty fair. And the third is pro rata. This is the big one. Investors with pro rata rights can continue to invest into your business at each successive round to maintain their ownership. The keyword is can invest. Pro rata does not force those investors to keep investing into your company. It just means they have the option at the next round to continue putting money in so they can hold on to their original ownership percentage. You don't give pro rata to everybody. You give pro rata to the leads of the round, maybe, and sometimes not always. So I have heard stories about people giving pro rata to all their investors, and then it comes to the next round. There's not enough room for everyone to take their pro rata, and it gets messy, and you have to annoy people, et cetera. So this is not a right that you give out to everyone. And now we'll talk about how the safes work in practice. Right now, if you're raising money in the US, if you raise $1 million, the median valuation cap on those safes is about $10 million. $1 million raised, 10 million cap means you sold 10% of your business, even though, of course, it didn't feel like that up front. You can see that the valuation cap of those safes is very sensitive to how much money you're raising, right? You don't do if you're raising $1 million, you don't do a 2 million cap because then you just sold 50% of your business. So in some ways, I don't actually care what the valuation cap is as much as I care about the expected dilution of this round. So if you do the YC example here, every single YC company raises money from YC on a safe. That safe has a valuation cap. No one ever talks about what that valuation cap is. They say, YC says, we're going to give you $500,000 for 7% of your business. So they talk about it in terms of dilution. You should think about it in terms of dilution. By the way, the valuation cap on a YC safe is 1.78 million, which does not sound as good as 500K for 7%.
That's a really low cap.
Really, it's a great, man, if you're YC, you get great deals.
Yeah.
All right. And then, of course, you're going to stick around on safes. If you're raising less than $2 million, probably you're going to do it on a safe. If you're raising more than 2 to 3 million, it's very likely that you'll get some lawyers involved and have a price round. I'll pause there for questions on pre-seed before we jump into seed real quick on the end here. Okay, cool. Seed fundraising. So this is a graph that shows you priced seed round valuations. So the orange line is the pre-money valuation, and then the gray bars are just the number of rounds. So two things are happening. One, Valuations right now are very high on a median basis. A lot of that is AI, a lot of that is excitement for companies, but you also have to take into account the round volume, how many rounds are actually happening. So higher valuations, but fewer rounds. So why is that? Well, investors, just like you, are kind of unsure what the heck is going to happen in VC for the next 5 years. Everyone has a lot of opinions about AI. What's going to be defensible? Which of these companies are going to last, et cetera, et cetera. So what's happening is that a lot of investors are slowing down their investment pace, but the ones that they're very excited about, they're willing to pay higher prices for. So more competitive rounds, but fewer rounds overall in the ecosystem. Good and bad for founders. On the whole, maybe bad because there's less capital being deployed. And again, if we split this by AI, which we've done here, you see that AI companies typically raise at higher valuations for more money, and they do so faster than non-AI companies. Which begs the question, what is an AI company? I have asked every investor that I know, quite a few, and all of them have given me a different answer, which means that all of them will give you a different answer as well. There is no one definition of an AI company. Sometimes people think you have to be competing directly with Anthropic or OpenAI in order to count. You have to be building your own models. Some of it is we have proprietary data to bring to those models. Some people just want you to use AI in the workflows of your company and be more efficient. All of that is happening. It's pretty confusing. So this is just a blanket statement that no one can tell you exactly what AI means or what you should use it for. Series A, same thing. AI companies have higher valuations than non-AI companies. So in those rounds, especially in seed, which we're talking about now, the median amount of equity that you're going to sell to investors is something around 20%. 20% in your seed round, 20% of your business in the Series A round. That's very common. You can see there's distributions there. Maybe if you're an AI company, you can sell a little bit less because you're, in higher demand, et cetera. But in general, those 20% marks hold for seed and Series A. Which means if you have an investor that's asking for 30% of your company in a seed round, you can point to this chart and tell them, hey, that's like the 80th percentile of dilution. That doesn't seem to make very much sense. Let's have another discussion about it. Or if you really need that money, you can take that deal. And then we come to how often you're going to be fundraising. So some of you said we're going to seed strap, which means we're going to take one round and then not raise again. That's definitely happening. There are many other companies who are trying to raise and they're just struggling to do so. So the time between rounds has gone up and up and up at every part of the venture ecosystem. It used to be that orange zone of 18 to 24 months. That was the standard. And now it's 2 years, 2.5 years, even 3 years between fundraising. So some of you are looking at this and going, no problem. I was only trying to raise one round. But many of you should be thinking, if I had to make this cash last for a lot longer than I expected, how would I need to change my business in order to make that happen?
Do you think, Peter, quick question. Do you think the time is expanded because companies are raising larger rounds, or is it just a harder fundraising market, so it's taking them longer? Or maybe it's
It's a combo. The rounds right now are not bigger than they were in 2021. So they're very sizable rounds, but they're not as big as they were 3 years ago. They're bigger than they were last year. So, some of this I think is elided by the consistent growth from basically, you can sort of see on each one of these charts, like, when did interest rates change? Early 2022. Boom. Like, things just shot up. If anyone thinks that startups are not sensitive to interest rates or like immune for some reason, that is totally wrong. Interest rates deeply matter for startups. All right, I'll end here with some notes on your ownership as co-founders. So we went through this a little bit at the beginning when you were splitting equity, but we can just go to this one here, which is This chart shows you on a median basis, how much does each group of people own of the company after the round? So just look at price seed. The day after you raise a price seed round, the founders, this bright orange column, own about 56%. The employees own about 11 to 12. The investors in that seed round own 20 to 21. And then the pre-seed, the safe investors, everybody else, they own 11%. So again, there's a couple things that stand out to me from this chart as intriguing. The first one is, over time, employees will own more of the company than founders. That's a good thing. You maybe will have hundreds of employees and only a couple founders. So on an individual basis, that's not true. But as a group, that's how it expands. The second point is the one that I'm always asked by founders who are thinking about taking VC, which is, when can my investors fire me as the CEO? The answer for most companies taking venture capital is between Series A and Series B, basically by Series B most of the time. Now, I don't want to paint it as though investors are looking to fire you. They are not. That is not true for the vast majority of VCs. They are investing into your company because you are there. However, in terms of ownership, which almost always equates to control, and we can talk about the difference if you want, Series B is where that flips, where the founders and employees have less than half of the company and investors as a group have more than half of the company. Venture capital is very expensive. We'll say it again. And we'll end with this one, which is just you as the CEO. How much are you going to own of this business? Obviously, at the beginning, it matters whether you're the sole CEO and founder or you have co-founders. That's a big deal. But you can see over time that that difference becomes less and less important. The disparity in ownership becomes much less. And so by the time you're a late stage company, Series D, that CEO owns between, call it, 7 to 10% of the business. That's a pretty good mark. It's a pretty good mark. Dario at Anthropic owns about 2% of his business right now. Of course, many of you won't hit 60 billion as a valuation, unlikely, but hey, that's the whole game, right? Dilution on one end and then valuation on the other. Hopefully the valuation is going up faster than you are being diluted. Tried to save 5 minutes at the end here I know we had a bunch of questions along the way, but what other things can I answer for you? How can I help here?
So much good stuff. Guys, this is your time. Pick Peter's brain.
That's right. Throw them in the Q&A, throw them in the chat. I will say, just as a last little pitch, the light blue launch there, if you're a founder and you've raised less than $1 million, you can get everything on Carta for free. So that's called launch. Scan that QR code, the left side. If you are already on Carta and you are trying to raise priced funding for the first time, like your seed or your Series A round maybe, scan that QR code on the right. We have this beta program where we're trying to save, this costs you nothing. We're trying to save founders money just by basically doing some admin tasks that lawyers used to do for you. So instead of paying billable hours, you can just do it on Carta. Again, it's a beta program, but if you're raising a price around it, we hope that we can save you some cash there. All right. Gal asks, why over 3 million you suggested to a price and not a safe? I don't actually suggest it. That's just where the data fell out. You can totally raise more than $3 million on a safe if you want. At some point, I wouldn't raise $10 million on a safe. Like, that's a lot of money. You should have more diligence. You should bring lawyers involved. Having a price per share is not a bad thing. It can actually set you up. For instance, if you are seed strapping, having a price per share makes it much easier to sell your business. And not have to deal with all this safe conversion and blah, blah, blah. So if you want to go seed to acquisition, having a price per share is actually a good thing at that point. Why do pre-seeds have less dilution than future rounds? Because you are valuing that dilution a lot more highly. And also the pre-seeds are for much less money, usually speaking. So if you raise $1 million on a pre-seed versus 3 or 10 or however many down the line. Can Carta help raise a pre-seed? We can help you look great to pre-seed investors. We can do data rooms. You can raise on a safe, all sorts of stuff. So yes, we can be very helpful. The only thing we don't do is we don't introduce you to investors. Price per share for employees is set in a 409A process. You don't set that in a safe. So oftentimes this gets confusing because you'll have one valuation of the company that is the preferred valuation for investors. And you have a different valuation of the company that is the 409A valuation that is for employees. Those two things are very different. And it's okay that they're very different. You want to give your employees the advantage of having joined early, and your investors are paying whatever they're paying for your business. So those are hugely split, Marcus.
Peter, on that, riffing off that a little bit, a lot of the companies or a lot of founders on here are hoping to do seed strap. If they do a safe and then don't raise a priced round, what
Yep,
kind of valuation or how do they determine the valuation when they decide it's time to convert that safe? Do you follow my question?
I do.
Yeah.
They could just take the cap and convert it to cap. But if it's been many years and you're just saying, oh, we're actually well beyond that, then it's honestly just a negotiation with those investors. You could a priori put terms like that into the safe, but most people don't. How many VCs are actually investing in safes? Every single one of them. Anyone who tells you that they're not investing in safes is not in Silicon Valley or hasn't done a deal for a while. Every single VC that we talk to that's investing at the pre-seed seed has done at least some safes. What data do you have on failed or closed companies over the last 3 years? Company shutdowns have risen a lot. We funded a ton of companies in 2021. A lot of those companies haven't made it, so they've shut down. Definitely happening. I'm just bouncing between questions here, so keep them coming. Founder-focused rating system for VCs. It's an interesting idea, Robbie. I don't think we're gonna do a rating for either founders or VCs. There are some people who do things like that, but probably not on the Carta roadmap anytime soon. How does a pre-revenue company calculate their valuation price per share? Douglas, this is a great question. Maybe I will be a little spicy here and say, if you are talking to investors who are only valuing your company at a pre-seed based on the money, the actual revenue that you have, they are not good investors. Your revenue at pre-seed, yes, people will want to see some revenue, right? But the actual, like doing a discounted cash flow analysis based on the revenue that you have at pre-seed is not a good way to invest into startups. It's a good way to lose a lot of money. I know this is annoying because oftentimes founders will come to VCs and they'll say, well, you don't have enough traction. You don't have enough revenue. But the model that the VC is using is not some super advanced discounted cash flow. They just want to see progress and momentum in your business. And they're just trying to say it in a different way. So now in terms of what's the market? It used to be that if you had $1 million in ARR, you could start talking to Series A investors. Now about something like 40% of the seed stage companies that we have on Carta have $1 million of ARR at the seed stage. So it's gotten a lot harder. And that's part of the reason why the investment has slowed down is because everyone is wondering what does good look like now? It's harder than it was 3 years ago, for sure.
But just to repeat that, 40% of the seed stage companies that raise at the seed stage have $1 million ARR. That's kind of a bar.
That's a bar, yeah. Now I should state up front, that is interacting with your growth rate. So if you're growing super, super quickly, you can have not that much ARR and start these conversations, right? But if you're growing more slowly, you need to have more ARR on an absolute basis. And obviously, we're talking mostly about B2B SaaS models here. If you are a biotech company, you don't have ARR. You're raising a seed round because you're trying to get a drug through trials. Those are different things.
Peter, I love, just in case we run out of time, I love Manfred's question though. Are you seeing different appetites for safes and valuation trends like for family offices? Do you have any insights into their appetite for safes?
I don't. I hear anecdotally a lot about how family offices are trying to go direct. Family office is such an interesting word. It means like a billion different things, even more than VC fund does. Family offices can be $20 million family offices or $5 billion family offices. So it's tough. I would imagine that like if you spend a lot of time trying to do family office investments or find them as founders, that's very difficult. But if you probably will run across more of them than you think. A couple other ones here. Shreyas, a percentage of startups in India that use Carta, not a lot. So I don't have a lot of Indian data for you, unfortunately. Luke asks, how does a company determine how many shares to offer? That doesn't matter. Percentage ownership is what matters, not the actual raw count of shares. Typically, what we see is that when companies incorporate, they start at 10 million shares, but they grow that over time. So Carta these days, we're a Series F company. We have, I don't know, hundreds of millions of shares. I don't even know how many millions of shares that we have issued. That number is not that important. If you don't have the denominator, getting 1,000 shares of a startup is meaningless. You don't know whether that's good or bad. Maybe a final couple questions here. Ellie asks, or Eli, sorry, asks if a company raised $10 million at a 20 million post cap in a seed, does my post cap need to be higher to include the prior safe convertible? The answer is yes. So this is the hidden thing with safes. If you keep raising at safe valuation caps, the investor in your price round is not going to be that happy about like all of the conversion that's going to happen underneath that price round. So you raise at a 20 million post cap, the next round is not for 20 million generally. That's not the goal. The next round would be for a higher valuation than that. So safes are great, but they set expectations that you have to hit. So do not treat safes lightly. They can feel easier and faster, but they are real fundraising that comes with real strings attached.
That's probably a good segue. I think we've got pretty much all of it. Let's let Peter get back to work. He's got a real day job.
Assuming I have a real day job, I just sit here waiting to get wound up again.
Yes, awesome. Guys, I don't know if there's a way to give thumbs up or whatever. Just thank you so much, Peter. This is super awesome. Just amazing. Really good stuff. And if it's cool with you, if you don't mind sending me your slide deck, we'll put it in I know some people asked in the chat and you mentioned people can contact you, but I'll just send it out to folks if you're cool with that and also the recording. So this is really good stuff. Thank you so much.
Absolutely. Yeah, I will send that deck over. And if anyone wants to follow along with us, if you're ever wondering Carta data, where can I get some? Carta.com/data. That's where all of our stuff lives.
All right. Thanks, sir. Appreciate
Awesome.
it.
Cheers, y'all.
Keep up the good work. Over and out. Bye.